we will jump right into 2026. So, Chris, I'm going to throw it to you first. What is the primary reason that stocks should do well in 2026?
Thanks, Troy. So yeah, we titled this year's outlook, some years it's harder to be a bull rider. So we're positive on the market, but are expecting there to be a fair amount of volatility here, particularly in the first half. But the number one positive thing that we see, and this is usually Charles' point more than mine, is earnings for the overall market look to be good and probably accelerating throughout the year, meaning the first quarter will grow high single digits. By the last quarter, the projections are to be in the 13 to 15% range, I think, for the fourth quarter. So throughout the year, earnings accelerating in the S&P 500. We've talked about in the past why that's possible, whether it's the big, beautiful bill, the no tax on tips and tax refunds that are coming in April to help stimulate the consumer, and a lot of capital spending going on here in the United States. So that's a big tailwind for the market for the whole year, starting after we get through kind of the first quarter as things start to improve throughout the year. So that's the first big one.
So when we look at the consumer spending aspect of this, you talk about no tax on tips and some of the aspects of the big, beautiful bill. It's not going to impact many of you who are retired or about to retire, but why is this important to the people paying attention tonight when they're concerned about the potential direction of the market?
Yeah, well, it provides lower taxes to a consumer, provides higher tax refunds, so there's more cash in a consumer's pocket. And we know most consumers here in the United States, when they have cash, they don't generally save it, they spend it. So I think the estimates are anywhere between $1,000 and $3,000 in additional tax refunds this year, coming up in April or whenever you file. So that should build really, towards the late part of the first quarter and help in the second quarter.
Logic tells us stock prices have a strong chance, no guarantees, to follow.
They're not going to do very well either. Yeah.
I think those are the right numbers, for last year, Troy, as you said. And then we had that detour in the middle of the year with the tariff tantrum,
and that's where I was going.
Which cut their earnings growth to nothing at one point.
Because they're estimates, right? Think about how you were characterizing them, and it's exactly right.
Yeah,
it's an important point, and that's why it popped back into my head, is an estimate. And those estimates can change, and that's very important too. One of the things that we follow is where, in looking at individual companies stuff, where estimates going up, right? Because that's usually an indication that businesses are doing better, right? Fundamentally doing better, generating more profits. Those are the sort of names we want to own.
Truly, and Charles has a great point. It's what the marginal dollars that they're spending is, right? It's not that Microsoft might not earn a return on all this money. It's that relative to, in the past, you went out and you bought a PC and Microsoft got a check for $100 and it cost them nothing, or a subscription revenue. Now they're spending tens of billions of dollars with the hopes and dreams that new revenue is going to come in, whether it's through Copilot or other software services that they sell. So, it's still a great business, but the market is very unforgiving from a timeline standpoint of what are you doing for me this quarter or next quarter? What's that marginal return? And if even if it's high, but if it's worse, say 50% going to 40%. Market really hates that. It much would rather it be negative return going to positive, like -10 going to 0. Your stock generally works better in that scenario. So it's what are you doing for me lately?
Do you think it's impacted at all that interest rates are higher? Or do you think it doesn't matter because the returns are so high, 0% versus 4%, 5%, 8%? What's the difference?
The market would be much higher at 0%. And I don't expect them to take it to 0%, but transitioning to the next positive is we're going to get a new Fed chair, in the next couple months. And we don't know who it is yet. It sounds like it's been delayed. It sounds like we're going to be told next week. They will be more dovish. And my expectation is we eventually do QE4 or something else like that this year, which I'm hoping causes kind of rampant speculation and we make a lot of money for our clients because we've seen this. Charles and I have seen this before, right? We're kind of on the path that we were on during .com and these other cycles. but it doesn't look like we're in the ninth inning. You know, it looks like we're kind of midway, maybe the sixth inning of it. So for all those people who call it a bubble, you know, I'll say, well, how come you haven't been long stocks and you're just kind of talking it's a bubble? So, you know, our job is to maximize our clients' returns in their investment accounts for the risk that we take. And right now, from an earnings standpoint, from an economic standpoint, there doesn't look like there's bubble risk in the public stock market.
Right.
There might be bubble risk in the private stock market. A lot of that stuff we talked about in a prior meeting with clients last week. Charles and myself went through in 1999. A lot of these companies that are now funded in the private markets used to come public very early on, and we saw them early.
That's what I was going to say. You know, you bring up a really interesting point, Troy. What if interest rates were zero? So it's effectively saying, what if their cost of capital was zero? During the internet bubble, their cost of capital was effectively zero, even though interest rates were higher, because the market kept accepting those deals. It kept funding the IPOs.
So are you saying that it was effectively zero because they could borrow it at 6, and then the price of whatever they were investing would go up?
They weren't even using debt capital. They were just using straight equity capital.
So it was zero.
It was effectively zero.
And towards dilution was the cost. But
that's right.
You know,
that's exactly right.
And towards the end of the dot-com bubble run in 1999, the Fed was cutting rates. They were cutting rates because of Y2K. They were afraid the economy was going to shut down. No computers would turn on. Everything would go black. So they were cutting rates, which has helped what caused the 100% run in the NASDAQ the last 6 or 9 months of the bubble, right?
What are some of the things that could go wrong this year?
Right. So the two things that were kind of on the list are, it's the second year of a presidential term, which is usually the sloppiest, choppiest, most difficult, because the incumbent president is trying to get everyone reelected. They're leaning on policies, but for whatever reason, the market tends to sniff things out and test them. So usually the first quarter is not particularly good in the second year of a first presidential term, which we're in. So, I mean, think about 2018 with Trump, right? We opened up very strongly in January, and then the market tanked like 12%, I think, in 3 weeks in February during Volmageddon. So not saying that's going to happen in the first quarter, but there are some things out there that there's risk to the first quarter just if something happened. We saw it today. The market was down 1.5% intraday and then rallied all the way back.
And then earlier this week, it was down, you know, when we threatened, there was tariff threats and market, you know, in a heartbeat down 2%. Sort of thing,
as we wrote in one of our weekend updates, you know, he's back in the meeting. You know, President Trump is back. He's out tweeting. He's making changes. You know, he's very tough. Shooting from the hip, right? Almost every week. So right now it looks like Iran is the thing that everyone's starting to worry about for the weekend. So that's the first one, is just presidential cycles. The second one is the market usually tests a new Fed chairman during the first year. So that would be, you know, the second half of this year. And I don't know why, but they usually do.
But you turn on the TV, it's crazy.
You know, the talk on TV is, you know, different than people's actions a lot of times in the stock market and stuff. I don't know. If I was watching TV, I mean, I'd probably be negative all the time, given
be hiding under the covers.
I mean, because, you know, if you turn on CNBC and Fox and the other ones, they like to sell fear, because fear catches people's attention. They stay, they watch. You know, if you say everything's great, everything's, you know, hunky dory, people just change the channel and go on to something else. They like train wrecks. But I know that the sentiment data that have come out recently in the stock market have shown a big uptick in positive sentiment the last couple of weeks, which is historically quite the opposite. It's negative. You want to, you know, when sentiment is low in the stock market, it's usually time to invest. When sentiment is high, it's time to start to slow down and curb your enthusiasm. So we've entertained.
What we do, we either build internally or vet all the investment products that go into client accounts. But if we don't have the skill set, to Chris's point, we will outsource that to whoever we think does the best job at the best price.
You know, and I'd say,
oh, go ahead. I was going to, the second question that I remember reading.
Well, I'll give that to you, but just real quick, I'd say we spent a lot of time over the past month critically looking at a lot of some of the most popular private equity investments out there when it comes to what's been sold to consumers and institutions for the past 5-7 years, really forever, but
it really accelerated, and we began to see some cracks in some areas of it. And
we're talking about private debt, private credit,
private credit, yeah.
So there's a lot of
and we saw this historically too in private REIT area.
We saw this
years
with
ago.
Public subprime mortgages. We saw this. We've lived this. We have literally lived this. It was just publicly traded. Now the same risk is being privately traded, which systemically creates a massive potential, a massively bigger potential crisis, because at least from a public standpoint, we were able to identify it at some point. Privately, you don't identify that until
it's pretty opaque.
Yeah, it's extremely opaque. So yeah, we had a pre-submitted question about private equities. Yes, we do have access to them, but the opaqueness of what's actually transpiring inside a lot of these private deals is beyond our comfort level to recommend to you in retirement. So. But for many of you, if you want to take 50,000, 100,000, 200,000, a small portion of your overall retirement, and you understand the risks, that one of two things is typically going to happen. By the time a private equity deal comes to you, you're almost the last person to be aware of it, and your returns are maybe 7 to 14%, and somewhere in that range. And one of two or three things is going to happen. You're going to lose everything that you have. Your money's going to get tied up, and you're probably not going to make a lot of money. Or you're going to make somewhere between 7 to 14%. That's what I've experienced throughout my career when clients purchase private investments from outside people. And we've seen a lot of it. I've seen people come in, oil and gas deals, real estate deals. Troy, I put $500,000 here. I can't access my money. It's tied up. Plans didn't go as expected, and I can't get my money. Or they lost it all. Oil and gas is far more risky because that often leads to complete, and here's the sales pitch, right? Well, even if you lose money, it's a write-off. Like, well, yeah, no shit. Excuse my language here, but I don't want to lose $500,000 and then you tell me it's a write-off.
Yeah.
So there's risk there. And again, we're retirement planners. Our number one job is to protect your money. So yes, those are available. We have access to them. We have people that do them reputably, but there is a tremendous amount of risk. So, okay. Second thing, Chris.
Oh, the other question we got was someone asked about valuation metrics, like the Shiller capital asset pricing model and the Buffett model or indicator. We don't look at either. Neither one is proven really predictive to timing cycles and markets, and I find, I understand Warren Buffett's valuation technique, but Berkshire Hathaway is an insurance company. It's not really an investment company that much anymore. So he's getting billions of dollars of premiums every month, and has the luxury to just let the cash build up on the Shiller capital asset pricing model. I'll hold my comments because I'll get in trouble otherwise.
So we have.